Hello and welcome. In this lesson we will continue our journey with the inheritance tax, as now we will look at some other bits and pieces which are only relevant to ACCA P6 taxation. Now this lecture is only relevant to P6, so you haven't seen these bits and pieces which we are going to see now. You haven't seen them before at F6 level. So even if you would have seen that, you might have forgotten that anyway. So, but you haven't seen this stuff which we are going to see now. All right. So we were discussing inheritance tax in the previous lessons as well, as you know. And I told you, if you remember, I told you that transfer to some parties are exempt. Now there were 4 of them, if you remember. Which one? Could you please remind me? Which one were the ones which were exempt? Could you please remind me? One was, I think, spouses, wasn't it? So if you make a transfer to a spouse, that was exempt. And other one was political party. Then it was for national purposes as well. All right. So there were altogether 4 of them. So when you make the transfer to them, then it would be an exempt transfer. All right. Now what happens is that when someone is going to die and in his own will, someone who has died, in his own will, he has given some assets. So he has written in the will that upon my death, I will transfer that many shares to my son, this many shares to my daughter, this many shares to my wife, and blah blah, and some charity and blah blah blah. So he will make some distributions when he is going to die. Now what happens is that you will see in the questions as well. Sometimes what the deceased person does is that they say that, say for example, my total deceased person says my total estate is £1 million. Out of that, I will give £200,000 to my daughter, £300,000 to my son, and the remainder of that to my wife. Now, what does the remainder means? Remainder means exactly the remaining one. So whatever the remaining estate is, I will transfer that to my wife. Now, the example which I gave you, in this example, he said that the remainder will be transferred to my wife. Now, if you remember that wife is an exempt party, isn't it? Likewise, if he says this many assets to my son, that many assets to my daughter, and the remainder of that to charity. So charity is again exempt. Political party, that would be exempt as well. So whenever they are making the transfer, the deceased person, if in the deceased person's will, it is mentioned that the remainder would be transferred to one of the exempt parties, then what would happen? There is a special rule on that, and which we are going to see now. All right. So I will just share the screen with you. Here you go. I've shared the screen with you. As you can see on the screen, it is page 68. Now, transfer of unused nil rate band, we've already seen that. Transfer of unused nil rate band, we've already seen that in the previous lecture. So you just need to read that one. And the next one, which we were just talking about, was grossing up gifts on death. That was the one which I was just telling you. Excuse me. Now, let's read. Then it says, the value of UK death estate must be grossed up on death before computing death tax when the UK death estate is transferred to chargeable persons. Now, the UK death estate is transferred to chargeable persons. Now, there are 2 types of persons. One are exempt persons, which are 4, I told you, and other ones are chargeable persons. Now, he will be transferring the assets to the chargeable persons, but it says estate to transfer to the chargeable persons, and the residue is left to the exempt recipient. Now, the remainder of the estate would be left to the exempt recipient. Now, how many exempt recipients are? We know there are 4. Now, this can happen when the residue is left to the exempt recipient. Now, this has come twice. So there was just one. It was needed only once. So the sentence has been repeated in the notes. So this can happen when the residue is left to the spouse or charity. So like I gave you the example that when someone dies in their own will, they have written that £300,000 worth of assets to my daughter, £200 worth of assets to my son, and the remainder of the assets, which are in our case was £500,000, remainder of the assets will be transferred to my wife for the charity. Now, if something like that happens, then we need to do the grossing up. All right. Now, how can we do that? It says chargeable amount in excess of nil rate band, whatever is in excess of nil rate band. So our nil rate band was how much? Yeah, for current year, our nil rate band is £325,000. Now, in the exam paper, normally the nil rate band will be £325,000 if the question is asking about current year or the previous year. However, if the question is asking about some previous years, so for example 2-3 years ago, then if the examiner is asking about that, then the examiner will also tell you that what was the nil rate band at that specific time. So you do not have to think about how much was the nil rate band then. So examiner will tell you what was the nil rate band at that specific time. So it says the chargeable amount which would be in excess of the nil rate band, and we will multiply it by 40 and divide it by 60. That's the way to do it. All right. Now, if proportions of the UK death estate is transferred to spouse, now in other example, now it is giving us another example. Now in another example, it says that transaction could be arranged like this as well. In our example, the total estate of the deceased person was £1 million. Say for example, he said £300,000 to my wife, £200,000 to my son, and the remainder to a friend. Now the remainder is going to a friend. A friend is not exempt party, he is chargeable person. So if something like that happened, then no need to do grossing up. If proportion of the UK death estate is transferred to spouse and other exempt parties and chargeable persons, and the residue is left to chargeable person, then no grossing up is required. That's why I told you. Now it says the foreign property does not need to be grossed up. So foreign property is exempt, so we do not need to gross that up. All right. Now after that, another rule, please, this rule is very, very important. Just like the previous one, the grossing up is important as well. But this one, which we are going to study now, it is even more important. It has been examined for quite a few times. Even I think it was examined in June 2014 exam attempt. So June 2018. June 2014 attempt, I think it was. So it was examined then as well. So it says a reduced inheritance tax rate on death estate. Now what happens is when someone is dying, and out of their own estate, what they do is that they leave some property, some of their estate, to charities. Now if they leave some property, some of their estate to the charities, then the tax rate on their death estate would be less than normal rate. Now could you please remind me what was the normal death tax rate? Excuse me. What was the normal rate of tax on inheritance tax on death? Yeah, you're right. The death tax rate was 40%. Now the death tax rate was 40%, and what was the inheritance tax rate during lifetime, if you remember? Yeah, lifetime tax rate was half of what the death rate is. Death rate is 40%, whereas the lifetime tax is 20%. However, it was more than that if the individual is going to pay that. If the individual is going to pay that, then it was 25% lifetime tax. Otherwise, if the trust is paying, then it was 20%, if you remember. All right. Now it's saying that normally the death tax is 40%, but if individual leaves some of their estate to charity, then the reduced rate of tax would be applied. And what is the reduced rate? The reduced rate is 36%. So they will save 4% tax on that. So they will have to pay tax at the rate of 36%. Now, how much of the estate they have to donate to charity? That is questionable. Let's read the notes. It says if 10% or more of the net death estate is left to charities, then death tax rate on the death estate is reduced to 36% instead of 40%. Now that's 10%. Now 10% of the estate is left to the charity. Now that 10% is after some deductions. Now what are the deductions? It says assets less liabilities, less exemptions, less reliefs, less available nil rate bands, but the charity itself, before the charity itself. So we will have to take out the reliefs, the exemptions, the nil rate band. So we'll have to take all of them, exemptions and reliefs and nil rate band. Whatever the net amount is, before taking out the charity itself, we'll have to take 10% of that. Now, if whatever the 10% is, if that much has been given to charity, then the reduced rate of tax would be applied, and the reduced rate of tax is 36%. So they will say they will save the tax at the rate of 4%. Now, this is very, very important, and it has been examined in the previous exams. If you check the exam kit, I think it is a June 2014 exam where it was examined, or December 2014. Anyway, let's move forward. Gift with reservation. Now, we know the rules for gift with reservation. I told you in the previous lecture, I think I mentioned it, but that was just a brief introduction. Now, it gives you a detail of the gift with reservation. Now, let's read. And it says there are rules to prevent the avoidance of inheritance tax by making the gift while reserving same benefit. Now, if you have gifted a property, say I gave you the example in the previous lecture, if you have gifted the house but you continue to live in that house, that would be considered as gift with reservation. Now, what are the rules for that? It says where a gift with reservation is made, it is treated in the same way as any other gift at the time it is made, as just like potentially exempt transfer and chargeable lifetime transfer. It says CTT, it's not CTT, it is CLT, chargeable lifetime transfers. However, special rules apply on death of the donor. What are the special rules? If the reservation still exists at the date of the donor's death, say for example, someone has donated the house, someone has gifted the house, but they continue to live in that house, and then they died. Now, if they died at the time of their death, they were still in that house, what would happen? The asset is included in the donor's estate, so the asset would be included in the donor's estate. Now, if you remember, there are different types of tax. One is lifetime tax, other one is death tax, and there is another something called death estate tax. So there are two types of taxes as far as death tax is concerned. So one is just normal death tax, which would be on the CLT or potentially exempt transfer, and the other one would be tax on the death estate. So in this case, if they continue to live in that house which they have gifted earlier, and at the time of death they were still living in that house, then it would be included in the death estate of the deceased person. All right. And the second rule says if the reservation ceases within 7 years before death, now please make sure read it carefully. If the reservation ceases within 7 years before death, then the gift is treated as potentially exempt transfer made at the time the reservation ceased. Now, it will be considered as the pet was made at the time the reservation was ceased. Now, say for example, if an individual was died in 2017, and at that time they were living in that house, they were not living in that house, but they were living before. Say for example, they ceased to live in that house in 2014. Now, although they have gifted the house earlier than that, but they have ceased to live in that house in 2014. Now, that date, 2014, will be the date which will be considered as potentially exempt transfer. So, we will not take the original date of the gift, because at the time of the original gift, although they have gifted the house, but they were continually living in that house until 2014. Then in 2014, he ceased to live in that house, and he died in 2017. So in that case, if it is 7 years before death, they have ceased to live in that house. In that case, we will take the potentially exempt transfer at the date when they have ceased to live in that house. All right. And it says that if the reservation ceases within 7 years before death, then the gift is treated as potentially exempt transfer made at the time the reservation ceased. The annual exemption cannot be used against such a pet. Now, that is an important point, that normally what we do is when we take the potentially exempt transfer, we deduct the annual exemption out of that. However, this potentially exempt transfer, we cannot deduct the annual exemption out of this one. That is very, very important point. All right. Let's move forward. There are a couple of exceptions to this rule on the next page, if you see. Now it says there are exceptions to the gift with reservation rules as follows. Now, if they have gifted the house and they are continue to live in that house, but they are paying a rent to live in that house, which is market rent, then gift with reservation rules will not apply. So it says if the reservation will still exist at the date of the donor's death, the asset is included in the I was reading the previous. It says a gift will not be treated as being with reservation if full consideration is given and the property is land or chattels. For example, an individual might give away his house and continue to live in it but pays a full market rent. Alright? And the second rule says that although when they have gifted the house, they were not living in that house. Alright? So someone gifted that house but they were not living in that house. But after some time, he was very, very ill, and his bad health condition, because he was old person and his condition of health was very, very bad. So that's why his son asked his dad to come to live in that house. Now that person, when he has gifted the house, he did not know that he will become so much ill and he will have to come back to that house. So which was unforeseen at that time when they made the gift. Now if something like this happens, this is an exceptional case. So although when they have made the gift, they decided not to live in that house. But what happened after is, because of the ill condition, because of the very sick condition of bad condition of his health, he has to come back to live in that house. In that case, and then he died in that house. In that case, also a gift with reservation will not apply. Now that's what it says in the B part. It says the gift will not be treated as being with reservation if the circumstances of the donor change in a way that was unforeseen at the time of the original gift, and the benefit provided by the donor to donee only represents reasonable provision for care and maintenance of the donor, being an elderly or infirm relative. Just the way I told you. Alright, let's move forward and look at some overseas aspects of inheritance tax. Now, when I explained the double taxation relief, I told you that it will be exactly the same for inheritance tax, capital gains tax, income tax, whichever tax is coming. Double taxation relief is exactly the same thing. So it will be double taxation relief will be lower of UK inheritance tax on overseas gross assets and overseas inheritance tax on overseas gross assets. Alright? Now after that, it is administration of inheritance tax. We've already seen in the previous lecture when to pay the tax and who shall pay the tax, and when the interest rate runs from. But what we haven't seen is installment option. You can pay inheritance tax in installments if the inheritance tax arising is on one of the following assets. Now installment option applies to land and building, shares or securities in a quoted company controlled by the transfer immediately before the transfer, shares in an unquoted company represented at least 10% of the issued share capital and valued for inheritance tax purposes not less than £20,000. And the last one is a business or an interest in business partnership. Now what happens is when someone has inherited an asset, say for example it was a business, and the son was a very, very poor guy, but the dad was very, very rich. Now when the dad died, the son inherited the house. Say for example it was a house or it was a business. We take an example of the house. So the son inherited the house because he was a poor guy. Now although he has inherited the house, but he has to pay inheritance tax on that in order to be full owner of that. But he's just a poor guy, he does not have any money. Now in that case, instead of selling the house to pay the tax on that, what government says is you can pay tax in installment. Alright? So it says if any of the following assets are inherited, so I have listed down the list as well. If any of the following assets are inherited, then you can, if there any inheritance tax arising on that, then you can pay it on installments. Alright? Now after that it says if a property is sold, then all outstanding tax must be paid. Now if you're going to sell the property, then definitely you're going to pay the tax. Alright? After that it says altering disposition made on death. Now whatever the will of the deceased person was, so when someone died, he has made a will. I will transfer that many assets to that person. I will transfer that many shares to that person. The remainder of the estate will be transferred to another person. Now, although that person has died, but what you can do is, if you are donee, so if you are inheriting the assets, now all of them people who are inheriting the assets, they can make the changes in the will. Now, how can they make the changes? So why would be they making the changes? Now, they will be making the changes in order to save some tax. So they will go to a tax advisor. So they might pop into your office and ask you that, our dad was a rich guy. When he died, he has given us so much property, but we have to pay a lot of tax on that. Now, could you please tell us some ways in which we can change the will so that we will have to pay less tax? All right? So it says altering disposition. How can we make it? By application to the courts. We can go to the courts, and by means of voluntary variation or disclaimer of legacy. All right? So first one is to go to the court, and second one is you can do it yourself. Application to the court may be made if the family and dependents of the deceased feel that the will has not been made adequate provision for them. Any changes to the will made in this way will be treated for inheritance tax purposes as if made by the deceased person when writing the will. All right? Within the 2 years of the death, the terms of the will can be changed in writing, either by variation of the terms of will made by the persons who benefit or could benefit under the dispositions, or by the disclaimer of legacy, with the changes being effective for inheritance tax purposes. And after that it says, inheritance tax will be calculated as if the terms contained in the variation replace those in the will. All right? And after that, there is something called advantages of making lifetime transfers. Now, we have already seen that in the previous lecture I told you, and this is very, very, very important as far as P6 is concerned, because it is highly examinable. Please make sure you learn this list, and this is very, very obvious. When you will read that, you will understand it, that they are very, very obvious rules, but examiner could ask in the question. And in fact, I think I showed you a question as well, in which the examiner was asking advantages of making lifetime transfers. Let's move forward. Then on the next page it says factors to consider when choosing assets to gift during lifetime. Now these are also factors which I've already told you. I've showed you in the previous lecture, factors to consider when choosing assets to gift during lifetime. So when you're gifting some assets, what you have to think about when making a gift during lifetime. Now these are also very, very important as far as this is concerned, P6 is concerned. After that, it gives you a table here. So it is a comparison of inheritance tax and capital gains tax. As I told you that inheritance tax and capital gains tax go hand in hand. So the same transaction will be affecting capital gains tax and inheritance tax at the same time. So what you will have to do is you will have to look at the transaction and think from the both perspective, what would be impact of this transaction on inheritance tax and what would be the impact of this transaction on capital gains tax. All right. Now it says that potentially exempt transfer. What is potentially exempt transfer? Gift to an individual from other individual. So you will have to pay lifetime tax on that or not. So it will be when you are making a gift from an individual to another individual. So for inheritance tax purposes, it will be a potentially exempt transfer. What would be CGT impact on that? Now, if one person gifts to another person, what would be the impact for CGT? Now, CGT payable in the tax year of transfer, market value will be taken as sales proceeds. Now, if you remember, in capital gains tax, when you are gifting something, you will not take the price what the gift price is. You will always take the market price. That's what it says. And after that, it says gift relief may be claimed if you want. What would be the impact of when you make a transfer to a trust? It would be CLT for inheritance tax purposes, and CGT would be payable in the tax year of transfer. Market value will be taken as the sales proceeds, and gift relief may be claimed. Now, as far as the death tax is concerned, potentially exempt transfer in CLT and death estate. Now, these are death taxes. However, there will be no impact on capital gains tax for that. And last one is gift with reservation. It is also death tax, so there won't be any impact on capital gains tax. However, there is one thing, gift with reservation lifetime tax. There will be capital gains tax payable in the tax year transfer. Market value will be taken as sales proceeds, and gift relief may be claimed. All right. So that was our inheritance tax, and we have actually finished our chapter, which is inheritance tax, and this was another very important portion of inheritance tax. This was another important portion of P6 taxation. All right. So that's it for now, and please make sure you do as much practice as you can of the questions of inheritance tax. In the next lecture, I will show you some questions as well, which you will have to attempt in your spare time, so that you can make yourself strong on these topics. I will show you some questions in the next lecture which you have to attempt for inheritance tax. All right, that's it for now, and I will see you in the next lecture. Goodbye.